Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Happy Friday, by the way. We're going to talk about the littlest difference that making a change to your investments can make. And I want to show that difference. I don't want to just be on the blackboard saying, oh, look at what you could make. I want to actually show you the difference using Nest Egg, our financial planning software that we give to every one of our customers. So here's what happens. A lot of people, as they go through their lives, they got a 401k, a Roth IRA, HSA, and all these things that have happened along the way. And you go, okay, well, this account's doing well, this one's doing okay, everything seems fine, so you don't think anything of it. Well, a lot of times, I would say 8 out of 10 times with customers here, when I'm digging through their nest egg, I find that there's room for improvement in their investments. And it doesn't necessarily mean that it's something we manage. It could be accounts that they have at work or maybe through former employers and stuff. And man, just the smallest change can make a huge difference. So I want to go over that and quit wasting your time here. Let's dive in. Here is Nest Egg. This is our financial planning software that we use. And we've got a demo person here, Louis Armstrong. And I actually didn't set this up. This is just coincidentally, like I said, 8 out of 10 times this happens. Coincidentally, this is exactly how it happens. So check this out. Let's go through what they're expecting here. Louis Armstrong, he's a 48-year-old male at the moment. His wife, Lucille's 36. They have expenses of $6,500 pre-retirement, doesn't include their mortgage, and they file their taxes jointly. Savings, he's putting 3% away in his 401k. I know I'm breezing through this. You can pause it if you want to see the details here, but I want to get to the goods. He's putting 3% in his 401k. He's got a primary match up to 6%, so in this case, he's getting a 3% match. 5% is going in Lucille's 401k. She gets the full 100% match there up to 5%, which she's getting. Louis Armstrong's got a Roth IRA with us here at Jazz Wealth because the name, we attracted him because of the name. $4,000 he's putting in a year, and he's increasing that by 2.5% a year. Lucille also started a Roth with us here. She's got $3,000, and she's increasing that by 3%. In case this isn't obvious, these two people are not real. Louis Armstrong was a famous jazz trumpet musician and a cool singer too, and Lucille was his last wife. Anyways, I have to say that just to be safe. Okay, Louis has an HSA also. He's putting $500 in there every single year, and so that's their savings. Currently, their income, Louis Armstrong, believe it or not, makes $98,000. Lucille makes $70,000. We're going to estimate their Social Security based on everything gets estimated inside of here based on current rates and everything. And we have one little bonus here. Louis Armstrong gets a music royalty of $20,000 that starts when he officially retires for the playing of his music, and et cetera, and all that great stuff. Now, speaking of retirement, their goal is to retire. Well, his goal is to retire at 63, and then she will retire at 63 as well. She was a great philanthropist, and she wanted to keep doing that through the rest of her life, working for different nonprofit organizations. We'll pretend. Retirement expenses, they'd like $7,500 in retirement, and we've got their estimated annual retirement healthcare cost at $5,238, which you'll see in a moment the HSA gets pulled from that. All right, Mr. Louis Armstrong has also linked his bank accounts here, so we've got $24,000 in checking. We've got a little bit of debt. The investments are here, and then they got some property. Today we're focused on the investments because, as I said, if we go to their retirement tab and we see what their probability of success is, it's only 52%. And every time I see that, I think, let me go to the investments. Let me see what's going on there. Chances are we need to tighten up. So if I go over to their investments real quick, we actually can see as a whole all of their accounts currently where they land versus where they should be based on what goals we've set, right? Their goal was growth. They can afford to be in a growth position right now, and so that would revolve around more 70-30 stocks and bonds. I don't like saying it that way, but they can afford to grow more. Average return around 7.6% is what they should be shooting for, or even more, provided we don't get any more volatile than what we see here. What he's currently, as a family, what they're currently experiencing is 5.9% average returns. Very low volatility, and that's okay. So whenever I see this with a customer, and I snoop around, when you guys set up your nest egg, I'm always snooping around in there looking. The first thing I do is go, okay, who's at fault here? Is it us here at Jazz? Did I let you invest in a way that's hurting you and I need to change that? Are you investing in your 401k or something that's hurting you and we need to help you change that? Remember, we help you with every investment that you have. If I notice a problem, I'm calling you up and we're going to work this thing out. So one of the easiest things you can do as a user here is you can click on action items and it breaks it down immediately and it says, here's the problem. You need more money in stocks. We knew that because we looked over here. But where are we going to get that money? It's saying, hey, you've got a lot of money in real estate. You've got a lot of money in bonds and other, in this case, we'll get to it in a second, but for at least the initial focus, we've got a lot of money in real estate, bonds, and international bonds. You go, okay, we've got to find some of that money and we've got to allocate it towards some emerging markets, a little international, or U.S. equities, depends on what their individual goal would be. So how can we do that? We can look, well, we can go in a number of different ways. I'm going to go the easier way for me. I'm going to go back to their profile tab here and go to their investments. Because what happens over here is it breaks it down by account, right? So it shows what accounts we have, and that's a good starting point for me. If I look at their Roth here at Jazz Wealth, we've got some international bonds. Uh-oh, remember, that was an issue. They had too many international bonds. Real estate, oh boy, okay. So maybe we've got the problem here, and it's our fault that we're letting them kind of be under their goal. We'll look at their 401k. So Louis Armstrong's 401k, we go, okay, we've got some bond ETFs in here. We basically have all bond ETFs and a low volatility ETF. So it's not all Jazz's fault in this case. We can look at that and say, wow, you're playing it ultra safe here. We need to talk about that as well. We look through Lucille's 401k, simple target date fund. We'll save that for last. And Mr. Louis Armstrong has just a couple stocks in his 401k in his investment account, taxable account. We got Ford and we've got Verizon coming in at 41,000 there, so maybe a little bit much. Okay, so if we go over here to the, well, first thing I want to stop on is this concentration tab, because anytime I see someone has a lot of one position, I always come over here and see if that's too much. And in what this is just me on the fly here. Verizon is a little bit high, so he's got 48,000 in the Verizon at the moment. It's very, very concentrated. About 10% of his retirement is based on Verizon, and we don't like that. So the consideration here is that he takes away about 23,500 from Verizon. Now, what do we know? We need more in stock. So this is a stock, but we know now we could take 23,000 of this Verizon. If he's okay with it and the taxable gain isn't such a big deal, we could actually diversify that a little more. So you already see how we're having choices here to get sort of dialed in. Now, if we look at the individual holdings here, we know from the Jazz Wealth accounts that we had a lot in bonds. We also had a lot in real estate. So if we sort by account here, we know that the real estate position was 52,000 there, right? We know that bonds are also a focus. Now, here's the thing. When you're looking at all this, you might be kind of confused and like, what do I do? I know the thing is telling me I need more in stocks and less in bonds and real estate, but how do I go about it? Well, remember, a Roth IRA is post-tax. So we want the most possible growth that we can get to come in the Roth. We think about like a pre-tax account. If we were to say, okay, Louis' 401k, remember, he was a lot in bonds. If I go over to his 401k, we had a lot of bond ETFs. So the last thing we want to do is say, Louis, take more risk in your 401k when his Roth also has the opportunity to take more risk as well. We want to grow as much post-tax money as fast as possible. The pre-tax money, if it doesn't grow as much, we're okay with that because we're just sort of staving off that higher tax bill. So remember, always take the most amount of risk in terms of going for the biggest growth in the post-tax accounts like the Roth. You don't want to grow a huge account and then owe taxes on it. So something to keep in mind there. Okay, so here's what we're going to do. We know that we can reduce in his Roth IRA, there we go, we can reduce his bond holdings, the international bonds, we could bring that down by 19,000 because we remember back on the other screen we had to come up with 19,000. We've got a lot focused on real estate. We can reduce that by 41,000, and without doing anything, we can move those funds to very aggressive or more aggressive. It depends on what Mr. Louis wants to do, because this is the Roth IRA. So if we go back to the retirement tab here, and now let's assume that we've had this discussion. We say, okay, look, you got a 52% probability of success. That's actually not bad in terms of how we measure this in the background. We'll have to do another video on that. It's not horrible, but if we really want to dive this up, then we know we've got to move you to growth, right? Where, let me go back real quick. So on the investment tab, we were shooting for this growth type allocation. We know now the flaws in your existing investments, and now what we want to do is go kind of simulate that. What happens if we make the changes? So if I go to a growth approach here, not changing any single thing else, that changes his proposed plan, hopefully a little bit better, 72%. Okay, which 72% is, I mean, that's really pretty good. You don't have to get to 100%, by the way. What this is showing you here is, on this screen, is when you likely run out of money. So the average is right here, this dark sort of bluish purple line, and then the different variables from the Monte Carlo simulation are landing both down here on the lower end of the spectrum and both the higher end. So it's not perfect. You don't, in every single case out of 1,000, you don't end up living or not running out of money before you die, but it's pretty close there. So in this case, by just simply adjusting the investments, huge deal there, we actually can put him in what's pretty much the most confident position he can be in with everything else that he's set up with. Now, what's the difference there? All that talking, all that blabbering is the difference between 7.6% average returns and 5.9% average returns there. Really, 1.7, was it 1.7% is all the difference in the world that made to boost him that much further. By going into his investments and dialing them in, right? Just that little change, if we can adjust that for him, he's that much better. Now, how many of you have seen a screen like this? You may have something that you're using that lays out all your investments. How many of you are able to find out that you are in the wrong position just by looking at this? I love doing this with our customers here at Jazz because now I have a way to quantify the advice that I give. A lot of other financial advisors, they're just like, hey man, somebody says you should invest this way, or we think you should invest this way. Prove it to me. Prove the dollars to me, right? If you have a larger account somewhere and you're working with an advisor and he can't prove to you why you're invested the way you are and that it will hit your goal, I love that stuff. I eat it up for breakfast. I'm only stopping this video here because I feel like you guys want shorter videos. So I'll wrap it up with that. Hey, we'll be back later to do the closing beat at 5 o'clock Eastern time. It's a live stock market update show that we do on our YouTube channel, Jazz Wealth Managers. We'll go over all the goods there and even include a few stats and everything for you as well. I hope you found this helpful. Let me know if you go this crazy with your retirement investments. Is somebody on your side like we are, right? For Mr. Louis Armstrong there. Anyways, thanks for keeping us in mind. jazzwealth.com if you want to check us out. Have a great rest of your weekend if we don't see you later, and enjoy.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.